As you know, we started our analysis for the microeconomics, the demand and supply condition, consumer surplus and producer surplus, welfare costs, deadweight loss, and those type of topics. And then we will try to cover the macroeconomics in financial market, stock exchange, GDP indicators, global macro indicators. Right now, we will focus on the financial market indicators, and we will try to cover the foreign exchange market and interest rate spread, and how the investors and market makers try to get the value and gain at the end of their operations. As you see here, we will get this screenshot from the Bloomberg. And as you see here on the top, you see the year to date to today, what's happening on the global return, spot return of the FX market in terms of the United States dollar. Okay, the base world currency. And as you see here, the best, the Colombian peso, approximately in 6 months, get the best return, approximately 22.5, meaning that the Colombian peso appreciates, gain the value against United States dollar, or Mexican peso approximately 15%, Albanian leg on 14, Brazilian real 11, and Iraqi dinar approximately 11 again, and the least one is the Moldovan leu. And if we focus on what is happening in the worst case, you know, the Lebanese country are in a crisis period, and because of those crisis period, they get a real return, decrease in their purchasing power parity, increase in unemployment, and especially the minimum wage approximately decreased from 600 euro to around just 100 euro minimum wage. For that reason, their country's currency just in 6 months depreciate against the United States dollar around 90%. And as you see here, this is my country, the 30%, the Turkish lira. What this picture giving us to you? First of all, you should think there is no any currency here in developed market. What we mean by developed market? We have, as you know, G7, like Canada, Australia, United Kingdom, Germany, United States, Japan. Those are the developed countries, and their GDP deflators. Their economic output is really high when we rank the world output. So there is no country here like Japan or Canadian dollar. Because of what is the main reason behind this picture is this. The emerging market economy, FX market, is a little bit higher volatility against United States dollar rather than the developed market. Because these countries' currencies are not a reserve currency, this is important. What we mean by reserve currency is this. You have a central bank, you have lots of obligation throughout the world. You are making imports, making export, you have government debts and those type of things. And you can't pay those debts, those imports amounts, anything like that, if your country's currency is not a reserve currency. You can't pay those money in your domestic currency. You need a reserve currency, like United States dollar, like Japanese yen, like British pound, or like Australian and Canadian dollar. Those countries don't hold reserve money in their central bank because they have their country's money is reserved first, and they have huge output with the rest of the world, and they have huge current account surplus, and they automatically gaining the economic reserves in their central bank. What we mean by reserve currency, let me share my screen again, rather than this one. I will bring another Bloomberg screen to you. Hang on a sec. Here we are. I'm sharing my screen. And as you see, here we have the XY. This is the dollar spot exchange. And in this basket, while we are calculating what is mean by the XY, it is Euro, Japanese yen, Great British pound, Canadian dollar, Swedish krona, and Swiss franc. And these countries' basket are weighted with 58% with Euro, 13% with Japanese yen, 11 or 12% with Great British pound, and less than 10% with Canadian dollar, Swedish krona, and Swiss franc. And if this DXY increasing, this means that dollar is gaining strength against this developed market as well. But as you see, the dollar spot exchange is just changing today 0.12%, even less than 1%. So if we look at, let's look at what is the overall 1 year changes, price changes throughout this year. Let's look at the XY screen and how it is changing. Hang on a sec. And I'm sharing my price changes in the XY dollar spot exchange. And here we have the basic screen. As you see, we have the dollar spot exchange starting from, let's say, throughout the year, December, as we hear, and it is just around 102. And today it is again 101. During 1 year or 6 months, those developed countries' currency is just volatile around 1% against the United States dollar. But when we look at our basic screen, the main screen, look at this one now. As you see, those DXY currencies, developed market currencies, in 6 months just depreciate 1% against the United States dollar, but Colombian peso appreciate around 23%, or Turkish lira depreciate around 31%. It is because these countries, as I mentioned a few minutes ago, these countries are the emerging market economies, and their countries' FX market is a little bit volatile. How this changes coming from? First of all, you should understand the basic topics here. Look at this one. This is best spot returns. This is year to date, approximately 6 months, and this is just 12 months. Okay, and when we look at the 12 months rather than the 6 months, as you see, silver, one of the commodity markets, is the best gainer around the United States dollar, or Costa Rican column or Albanian leg, around in 1 year 20% appreciation against United States dollar. But when we look at, as I said, 1 year changes, it is around in Nigerian naira 43%. It is a huge depreciation, meaning that your purchasing power parity against United States dollar or Big Mac index decreasing 40% in 1 year. Let's say you are getting with your money this year approximately 100 bread in the market, but right now you will just get 60. Your 40 bread will be evaporate and melt because of the depreciation in your domestic currency. Okay, and we will try to think about what is the basic reason behind this picture. How the country's currency appreciate or depreciate against the base currency in the world market. The basic reason is coming from the trade. Okay, import and export. Let's say you have a huge export, and when we compare your export with import, your import amount is really lower. Let's say 20% of your export, and you are exporting your all goods in the developed market, meaning that you are selling $100 million goods and services to the rest of the world, just importing $20 million from the rest of the world, meaning that your trade surplus is $80 million in each year. And this $80 million coming from in United States dollar, euro, or any other reserve currency to your central bank. So from the basic demand and supply condition, what we know, if the amount supply is excessive in the market, price will decrease. Okay, so if you have less dollar in your market, the price of dollar will go up. But if you have huge amount of dollar in the financial market, the price of dollar will go down. So throughout the trade deficit and surplus balance, you are exporting, but you are less importing. You are gaining from the trade balances every unit you are getting the dollar amount to your reserve balance, then the dollar cost, the currency of dollar started to decrease, and your country's currency started to appreciate against United States dollar. So if you look at this picture, when you see these huge currencies, this is coming from basically from the trade balance. Okay, but for instance, for the Russian ruble, okay, what is the basic reason? Because as you know, Russia is the biggest importer of the oil product, commodities like aluminium, palladium, and those type of things. So Russia giving a trade surplus, they are selling more than they are importing. But why their currency is depreciating? Because of the political crisis. Okay, so even if you have huge trade account surpluses, if you have imbalances in your political governance, in your economy, in your government sector, if those type of political crisis you have faced in your country, this means that your country is again faced with an depreciation against United States dollar. Rather than the trade surplus and balances, what is the basic reason behind this? How your country's currency can face with depreciation or appreciation against in the FX market. The basic reason after the trade surplus, the second reason is the interest rate differences. What we mean by interest rate differences? All around the world, countries and capital try to get the return in their currencies. How we mean by and how we calculate this? Let's say the domestic currency in financial market giving an interest rate I, and let's say the international market offering an I star interest rate. So if the spread difference between I and I star is higher, meaning that your country is offering higher interest rate return when we compare with the rest of the world because their I star is less, meaning that the portfolio money is hot money, just looking for the return. Okay, their basic fundamental is just getting the return, not focusing on direct foreign investment, not focusing on factory, not focusing on the long-term investment perspective. They are just focusing on the return. They will invest, they will get the return, and they will come back again to their host country. So if we focus on the interest rate spread, interest rate differential in the financial market, it is the second reason which is directly affecting what is happening in FX market. Let's try to look at. First, you will understand the trade deficit and surpluses directly affecting your country's appreciation and depreciation against United States dollar. And the second reason behind that, the interest rate differences. Let's say we are living in Nigeria, and let's say our central bank started to increase the interest rate approximately 40%. Okay, let's say today the policy rate in Nigerian market started to increase 40% for 1 year by the Nigerian central bank. And we know today the Federal Reserve funding the market in United States just with 5 and 5.5%, between 5 and 5.5%. So we have a huge difference. What is this difference? This difference is 35% in return of the Nigeria, because money know that if I invest my money in the United States at the end of the year, I will get just 5%. And if I invest my money into Nigerian market, I will get at the end approximately 30% return. And let's say their dollar return is around 10%. Dollar return in the United States is just 5%, and dollar return in Nigerian market is 10%. So every investor knows that if I go to the Nigerian market and if I invest my money at the end of the year, I will get 5% higher in United States dollar against my currency. And at the end of the year, I will bring my money back. And what is the risk the investor take? You should think about it. This is the basic reason. So you can ask me, Dr. Dogan, could every investor put their money in any market which is offering higher return? No. the basic reason you should first be assume and assure that you should understand that if I put my money in Nigerian market with 10% United States dollar return, I should expect that during 1 year, the Nigerian dollar shouldn't be depreciate more than 10% against United States dollar. Otherwise, I will get zero. Because when I invest in Nigerian market, I will bring $1 million, converted it with Nigerian currency. Then I will put my money in the domestic market. And during 1 year, I will get the 10% return. But if the Nigerian currency will depreciate during 1 year 15%, I will lose 5% additional. Okay. So after I invest my money, the domestic currency should be stable against the United States dollar if I try to get a real return, positive real return. Okay. Then let's look at the map about when you see any notation like PPP, it is just purchasing power parity. What does this mean? Purchasing power parity. Purchasing power parity is the real value of your money around the world. I mean, you are trying to get and invest, just say, you are going to McDonald's, you are trying to get one hamburger, and you try to evaluate that money in terms of other currencies. So the index, the purchasing power index, purchasing power parity index, it is generally calculated with Big Mac index. If you calculate this, look at this is a ceremony from the Turkey because we are in a Muslim country. Okay, it will just pass in 2 minutes. As you see here, look at this picture. What is Swiss franc showing here, or Norwegian krona showing here, and what is the Russian ruble showing here? This is, look at this picture. This is the threshold value, 0 line. This means that directly showing us that if I try to buy a Big Mac in any country, the purchasing power of the Swiss franc, according to those Big Mac index, is the highest, and the Norwegian krona is following it. Swedish krona and Canadian dollar also positive, meaning that if I get one Big Mac in terms of the Swiss franc today, next year or during the last year, I'm getting 1.5% more Big Mac in according to Swiss franc. But if I try to do this with Russian ruble, if I get 100 Big Mac last year, today I'm getting just 60 Big Mac according to Russian ruble, and 60 or 40 Big Mac is melted by because of the currency depreciation. So we are trying to equate and evaluate what is happening according to FX market, and we are trying to how the purchasing power parity of those countries changing according to Big Mac index. And if you hear any word like Big Mac index, this means that you are just evaluating the purchasing power of your country. Okay, purchasing power of your money. And here, as you see, the interest rate return and ranking during 1 year on the y-axis, and here the Big Mac on the x-axis, and how many Big Mac you are getting in terms of those countries' currency. The best one is Swiss franc, and the worst one is Russian ruble. As you see, from the purchasing power parity, you can understand which country's currency is overvalued or undervalued. So, as you see here from the picture, I can get higher Big Mac with Swiss franc, Norwegian krona, or Swedish krona, or Canadian dollar, rather than, sorry, just Here we are. There is a problem in voices. Now, as you see here on the x-axis, the Swiss franc, Norwegian krona, Swedish krona, and Canadian dollar is getting the higher Big Mac in the world. From this picture, you can understand directly that these countries' money is overvalued, meaning that these countries have a huge trade surplus, these countries have a huge capital inflow, and their domestic currency is appreciating against United States dollar, and they have huge amount of dollar in their reserve currency. Okay, they don't have any leakage from the dollar, but they have more dollar than those countries have, let's say, Swiss franc in Switzerland in their central bank, have higher amount of dollar in their central bank than the United States have Swiss franc in their Federal Reserve Bank. So because of these imbalances, because of Swiss franc is huge, have huge amount of United States dollar, the price of USD is decreasing. And with Swiss franc, you are getting huge amount of Big Mac index. And if we focus on the undervalued currencies, as you see here, the undervalued currencies are this one: the Hungarian forint, Argentinian peso, and the least one is Russian ruble and Turkish lira. This is meaning that these countries' real effective exchange rate and the overvaluation and undervaluation is really, really undervalued, approximately 75% and 63% against the United States dollar again. And when we look at the best return in interest rate markets, as you see, this is just 3 months, best return in interest rate, okay? And as you see, whose countries' currencies are fragile, volatile, and depreciating most against the United States dollar, they have the higher return. Why? Because if your country's currency is depreciating, you should offer the high return to the rest of the world and try to get capital inflow into your country. Let's think this. If the United States Federal Reserve giving 5% to United States dollar, and if the Turkish central bank or Egypt or Argentina give the same interest rate, 5%, is there any investor who is going to the Egypt rather than the United States? No. You should offer higher return for investor to persuade them to bring their capital to your country. Okay, this is the basic reason. Because your country is fragile, your country is risky, you should offer the highest return compared to the United States Federal Reserve policy rate, so the capital inflow will bring your country and your country start to appreciate their currency. So as you see, the higher return in Argentinian peso, Turkish lira, and Russian ruble. And as you see here, the Japanese yen, for instance, it is worse interest rate return because they are not offering any higher return. Their country is stable. They don't need to bring capital inflow and appreciate their currency because Japanese is giving trade surplus, and because they are gaining in terms of United States dollar, if they let to the appreciation of the Japanese yen, they will get less United States dollar. So they don't increase their interest rate. So their interest rate returns is really low. If you are a real investor, you will go to the Japanese with the least return rather than go to the Mexico with a higher return. Because we have a saying in Turkish, one bird at hand is better than two birds at the tree. Okay, in Japan, you can get your money at the end in real and with a positive return. But if you try to get your money in Mexico, you can face with a political crisis, you can face with a financial crisis, and you can face with a FX market crisis as well. And even you can't get your initial capital out of the country. So while looking at the investment market, you should focus on first liquidity, risk, and the return. And these are the year-to-date deposit rate changes. So which country offers and how their deposit rate in the banking system changing year-to-date approximately in 7 months. And as you see, the Swiss franc deposit rate changed because if you follow the financial market, Swiss franc offering a negative return in their deposit rate. And Swiss franc at the end, as you know, just think this. You are bringing your money in Swiss banking system. You are bringing $1 million in fixed term deposit, government securities, and something like that. There is no risk. This is fixed income securities. And at the end, for your $1 million, the Swiss bank saying that you will get at $990. You are losing $10,000. Why? Because they don't want to people bring to their money into Swiss banks. Okay, they don't want to people to save higher money. They want to increase their consumption rather than the investment and saving. So they are decreasing their interest rate because of those reasons, and especially during the COVID crisis, Swiss banks offer negative returns to any investors to the rest of the world. But right now, their changes is higher. But if you focus on this 200% change, don't think this is the highest amount because this is coming from the base effect. What is mean by base effect? If you increase from 10 to 12, what is the increase percentage change? It is just 20% because you are increasing from 10 to 12, just two amount from the 10, and 2 over 10 is just 20%. Okay, you are increasing 2, but increase is just 20%. But let's say Swiss franc offering 1%, and let's say it is increased from 1 to 1/2. Increase from 1 to 1/2 is 50%, but increased amount in nominal value is just 0.5. In the initial case, previous case, we have increase in 2%, but the total change is just 20%. But right now, I'm increasing 0.5, less than 2, but the overall changes in percentage terms is 50%. Because the Swiss franc offering lower amount, any change is a higher percentage change term. It can be coming from the base effect. But when we look at the Turkish lira again, it is approximately 73% because the Turkish market policy rate changed from 8% to 15%. It is approximately 75% change in terms of the deposit rate change. And look at this market. These are the Japanese yen or Polish zloty, which is one of the best emerging markets. Their countries have a lower return in their deposit change because they don't need any additional offering to the rest of the world to get any capital inflow because their country's outlook is stable, not the volatile and not risky. When we come back, higher deposit returns, not the changes. Today, you are an investor in Nigeria, you want to put your money in any bank in the world market, and which country is offering the highest return? It is Turkish lira. Okay, if you bring your money in Turkish lira with domestic currency, at the end of the year, just 1 year maturity, you will get 35% at the end of the year. Or South African rand, it is just around 9%. Okay, but the 35% you are getting according to domestic currency. Okay, let's say you bring $1 million. Okay, today the currency FX market, United States dollar, Turkish lira is 27, meaning that 27 million Turkish lira. You are bringing $1 million and you are getting 27 million Turkish lira. And you are putting that amount into Turkish bank. Turkish banking system saying to you, if you bring 27 million to the Turkish bank, at the end of the year, you will get 35%. What does this mean? What is the 1/3 of the 27 million? It is approximately 9 million. So at the end of the year, your 27 million Turkish lira will be 36 million Turkish lira. But what we are expecting and what we are taking into consideration while making investment, the stability in the FX market. I bring 27 million. At the end of the year, my 27 million increased to 36 million. But let's say when I bring my money, the FX market, FX rate for Turkish lira and United States is 27, and let's say it increased to 50. What I have now, I have, if I convert my money my 36 million Turkish lira to the United States dollar with 50 currency rate, it will be $800,000. I'm getting 35% return to $1 million, but with this 35% return, I'm getting at the end of the year just $800,000, meaning that $200,000 is melting because of the exchange rate loss. Okay, not the deposit rate is just meaningful on itself. I should look at the stability in the FX market and interest rate return at the same time. Okay, so it does not mean for you to bring your money in interest rate market, put your money, get the interest rate return, and you will get a positive return. No, it's not correct. Okay, this is not correct. If the interest rate return is less than the FX appreciation, you will get lost your money. Okay, you should focus on two things. Term deposit will be higher and stable, but the FX market should be more stable. Okay, to get a real positive return at the end of the year. And now, these are the implied rates for the countries. What does this mean? Today, the country has a policy rate, and at the end of the 1 year, we have an implied volatility, implied rate for the deposit returns for the countries. As you see again, the fragile market like South Africa, like Hungary, like Brazil, like Turkey, like Egypt, these are higher implied rate because their implied volatility is higher. Look at this picture now. Highest volatility is in the implied market. What does this mean? You are putting your money, but please take into consideration this money can be subject to any loss against the FX market. Okay, you will get your deposit return, but you can get at the end because of the FX depreciation. So these are the highest volatilities and highest implied rate in the FX market, and we should take into consideration those issues as well. And here, when we look at 1 week highest volatilities, Russian ruble and silver and Turkish lira is here. But when we look at just historical 1 year volatilities, it is palladium, platinum, silver, Norwegian krona is the highest. Do you think what is the reason behind? Because of the volatility in these commodity markets, what can be the basic reason? Just to make a brainstorming. It is because of the Russian-Ukraine war. Because of the Russian-Ukraine war and the political crisis, all commodity markets, oil, palladium, aluminium, silver, coal, iron, all commodity market is increased during 1 year. I will reflect that screen as well. Hang on a sec. I'm sharing my Bloomberg screen again. Here we are. Look at this screenshot again. We are in Bloomberg. Here we are. Look at this global commodity returns. As you see, this is a living data. Okay, and this is the percentage change year to date. But if I can take this change for 1 year, look at this now. Everything is changing. As you see in energy markets, we have something like this. As you see, just look at this global commodity prices and 1 year return. What is happening here? Because we have huge volatility during the global financial crisis and COVID crisis, and Russian-Ukraine war. When we look at the oil and let's say iron ore prices, look at this one. Look at its graphs, and let's look at it with the start of the Russian-Ukraine war. This rise, as you see, in palladium and aluminum market also trigger the coal and those type of markets because of this increase coming from the Russian-Ukraine political crisis. And all commodities started to rise during those crises, and people suppose that all supply chain will be breaked and all costs will be rise approximately in 3 years. But because of the sanction, because of the alternative ways to import oil and gas products from the Iran and some from the other commodity producer market, the country's commodity price and world economy's commodity price started to stable out. And let's return our base scenario and base presentation. As you see, because of the war effect, these huge commodity market have a huge volatility, meaning that they increase suddenly, and after the sanction and the measures taken by the rest of the world, it decreased gradually. Then they have a huge volatility during those years. And right now, when we look at year-to-date best carry trade returns, Argentinian pesos to United States offering the best carry trade. What we mean by the carry trade? Carry trade is this. I'm borrowing from the country who gives the money with the lower interest rate, and I'm putting my money to another country who's offering highest. And the best carry trade return is offering from the Argentinian peso, Colombian, Mexican, Brazilian real, Hungarian forint, Polish zloty, and Great British pound as well. And the volatility in the Great British pound is coming from because of the Brexit. After the Brexit, from the 140, the Great British pound depreciate approximately 110, 30% around depreciation, and it started to recovery process, and it started to increase, and even GBP and USD, if you this meaning that if you look at the terms here, it is long and the short. What does this mean? In financial literacy, long buy this and short mean sell this. Okay, it is saying that if you buy the Great British pound and if you sell the United States dollar, you will get approximately 7% return during the 7 months. But if you do the same in Argentinian peso, if you borrow Argentinian peso, but if you sell the United States dollar, it means that you will get 30% return in just 7 months. It is a huge amount of money because this return in United States dollar, not in domestic currency. Okay, just in 7 months, according to United States dollar, getting a 30% return is a huge amount of investment. But if you do the reverse, if you buy the Turkish lira and sell the United States dollar, you will lose 17%. Or if you do the same in New Zealand dollar or South African ZAR, you will get 2% loss during the 7 months, according to the financial market condition. As I said, you should look at the financial literacy condition there. You should focus on what those countries offering, which country is offering highest return, and what are their FX stability. If those market is stable according to a fixed market condition, I can invest those countries as well. And CDS, narrowest CDS and widest CDS. By the way, is there anybody I don't know who is hearing about the CDS? But CDS is directly showing with just one word the risk of your country. It is an abbreviation of the credit default swap. Credit default swap is showing this. Your country, your government is going out to United States because you don't have enough saving in your domestic currency. You need some borrowing to finance your infrastructure. You need monetary policy and fiscal policy to expand your consumption. And you are borrowing from the rest of the world. And the investor in United States or Germany is paying to this. Normally, if the Canadian government comes to me and if they want to borrow the money from me, I will say this. What is the policy rate in the United States? It's 5%. Then, because your country's risk is lower, you can borrow the money with 6%, just 1% higher, because you are a stable country. But you are coming from Nigeria, you are coming from the Kenya, or you are coming from the India, and your country is risky. So if the United States federal funding rate is 5%, you should pay the amount at the end of the year as 11%. And this 6% is the probability of your default, credit default swap. Okay, if your country is risky, you should pay in return higher. What I said a few minutes ago, one bird at hand is better than two birds at the tree. American investor knowing this. If I give this money to Canada, I will get this money at the end with a sure. But now, if I bring this money to the Kenyan or Nigerian or Indian government, I can get a probability of default, and I can get a delay to my payment. So I should increase the cost of this borrowing, and I'm increasing the risk premium, and this risk premium is credit default swap. So what is the lowest credit default swap around the world? The stable countries, because they can borrow whenever they want and from whoever they want. Norway, Sweden, Japan, Switzerland, New Zealand, Australia, Great Britain, South Korea, and Czech Republic is the lowest. This meaning that just 0.03, this is basis points. So you should divide this number to 10,000. This is 33%. 33% over 10,000 means this is really, really lower, trivial amount. But if you go to the Argentina, this is 5,000. What does this mean? If Argentinian government go to the United States and try to borrow some money, they will get this amount with 55%. 55%, not 5%, 55%. Norway gets same amount with 6%, but the Argentina will get same amount with 55% interest rate cost, because their country is risky, and investors will add the credit default swap, the default probability, to their cost of funding. So if you increase the stability of your country, macro outlook, budget balance, current account balance, GDP, FX market, and interest rate market, the cost of borrowing around the world for your country is also decreasing. But if you are not stable, you will get any amount from the rest of the world with a higher cost. And as I said at the initial of the presentation, the purchasing power parity condition, according to Consumer Price Index, is best in Swiss franc and British pound. They are saying that if you have Swiss franc and British pound in your wallet, you will get highest Big Mac in all around the world. But if you have Japanese yen, according to purchasing power parity, you will get the least Big Mac index, hamburger in McDonald's, with the Japanese yen. Okay, this is because of the monetary policy and fiscal policy after the COVID crisis that is followed by the Japanese government. They are really letting their country's currency depreciation and really huge outflow. And because of those, purchasing power parity of the Japanese yen is decreasing. And now, the last slide from my presentation is real effective exchange rate. We have spot exchange rate and real effective exchange rate. What does this mean, real effective exchange rate? This is mean by this. If you have a spot exchange rate, and if you adjust the spot exchange rate with the inflation between two countries, this will give the real effective exchange rate. And the real effective exchange rate is highest in Polish zloty and Singapore dollar. What does this mean? If you have Polish zloty and Singapore dollar in your pocket, you can go and travel all around the world because their purchasing power and real effective return is highest. But if you do the same with Japanese yen or Norwegian krone, their return is lower. What is the basic reason? Because here we see that purchasing power in highest in Swiss franc. But why Swiss franc is not here? Because it is what I say, the spot return is adjusted according to inflation adjustment. So the inflation is really low in Swiss franc, but right now in Polish zloty, also inflation is higher and real effective exchange rate is offering higher purchasing power parity for your domestic currency. This is the end of my slide. I'm here to answer all questions for FX market, financial market, and interest rate firm. Thanks for your patience and contributing and listening all the presentation.
Thank you. If any of you have a question, you can raise the hand reaction or leave a comment in the chat. I have a few questions here in the chat. Let's read them. For example, malicious ask, why are the commodity markets increasing during crisis? Sorry, Dogan, did you hear?
I couldn't see the question is there, but let me answer those questions. In the crisis period, if we have a crisis period, if we have a problem in political economy, in financial market, in something like that, every people go to the commodities rather than the cash money. What is the basic reason behind this? Because what is the name of the gold all around the world? Hang on a sec. Okay, I'm here again. What is the another name for the gold? Do you know all around the world what is the name for gold? It is safe haven. Okay, safe haven. If you see any risk in the market, if you see any war in the market, if you see any crisis like COVID, like global financial crisis, like UBS Credit Suisse crisis, if you see any crisis and risk, you will directly go to the commodity, gold, silver, and those type of things because they are not money, they are safe haven. So you will increase your all demand to the commodity rather than the equity and risk asset. So their demand is increasing during the crisis period and their price is going up. But in Russian crisis, rather than the demand increase, also supply chain is also important because Russia cut the supply for the natural gas and oil products and the price is going up. Also, always think this: demand increase, price increase; supply decrease, price increase. Okay, because supply decrease during the Russian crisis, prices increase rather than the demand. Any other question?
Okay, we have a question from Emmanuel. Let's see what he has to say.
Hello. Good morning, good
Hello.
afternoon, good evening.
I couldn't get the voice, by the way, for the question.
Emmanuel, you muted yourself.
You can write the question here in chat side as well. I can easily read and answer those questions as well.
Okay, let's hear this other question. in case Emmanuel writes his own.
Okay. I think there is another question here. The borrowing from IMF to poor countries such as Argentina, Ukraine, being risk market, does it help the countries to recover or dig deep their debt solve? Okay, this is a good question. Lots of countries, if they have a payment problem or if they have a currency crisis and something like that, they try to get the support from the IMF or World Bank for any other condition and payment obligation. Yes, if you don't have a plan and if you don't have a stability program for your macroeconomic indicators, they can dig the deep for your debt. But IMF does not let to do this open, because IMF, if bring the money to your country, they will send their expert and they will send their attendees to your government sectors, and they are following how you are consuming and spending those money. Okay, they are not giving free money to you and to spend all those money however you want. Okay, all they are follow it, all they have a plan issue. So if the IMF support coming from country, IMF experts and IMF obligation is also coming from those countries as well.
Okay, let's see what Zainab has to say.
Okay, Zainab, we are waiting to you.
All right, good evening. I am Zainab from Nigeria. Hello?
Yes, I'm hearing you.
All right. My own is a very straightforward and simple question. I will take Nigeria as a scenario whereby everybody is looking for an opportunity to exploit one another, and then maybe put it in a place whereby it's a global thing. I'll give you an example. Recently, in the year 2022, where we had shortage of cash flow because of the forex policies in the country. It turns out to be that it's only one person that monopolized that that forex policy, and then now the blame is on the Western world. My question is, why is it that it's easy for prices to go up and it's very difficult for prices to come down when everything is in order? Thank you.
Thanks for the question. As I said, the world financial market and FX market directly affect from lots of sources, but the basic fundamentals from those or among those sources is the trade balances and interest rate spreads. You should focus on those two things. If your country exporting more than imports, you will always gaining and keeping reserve in your central bank. Or rather than that, if you're offering a highest interest rate return when we compare to the rest of the world, it will stable your country again. But sometimes, despite you have huge trade surplus, despite you are offering higher interest rate return, your country's currency suddenly can depreciate against the rest of the world reserve and emerging market currencies. And this comes from the political shocks. For instance, let's say the prime minister suddenly killed by a thieves on the street. This is a political shock. Even your country is a stable country, this will give an overshooting hypothesis, a sudden shock to your FX market and your country's currency during one day, or let's say 1 week, until the new government and prime minister attain to the government. Your country's currency will be volatile and will face with depreciation. But it is not showing that the short-term volatility or short-term depreciation does not mean you are going wrong. It is just an outlier. It is just a shock from the rest of the world, supply side shock or demand side shock or internal shock from the political or economic side. And this can be a temporary shock. It will be pass away. So the question I see on my screen is why Jamaica is not included in the list of the world currencies. Actually, it is included, but because the screen is just making a rank, it is getting 9 highest and 9 worst, lowest. So if we make the detailed return, it is in the list of the world currencies, but it is not in the list of the reserve currencies. Okay, reserve currencies is just 7, not the, for instance, Jamaican dollar or Turkish lira or Nigerian dollar. Those are not reserve currencies. Those are just currencies, not reserve. Okay, I think there's a last question here, but I couldn't get the voice.
We have a question from Jeffrey. Let's see
Yes.
what he has to say. He's putting. Hello, Jeffrey. You are muted. You can also write the question in the chat.
Yes, you can also write the question.
We can hear you.
We can't hear you. You can write in the chat side.
In the meantime, since we have another question, let's see.
Okay, I'm answering until you write another question. Great presentation. I'm Emanuel Afari. Please, if you could explain further the difference between high interest return and high carry return. High interest rate return is this. High interest rate return, you are getting high return in domestic currency, but carry trade is this. You have a responsibility, you have a brand name, you have a capacity to borrow from any currencies. You are going to the country who is offering lower borrowing costs, getting those money as a borrowing, and you are putting that lower cost money to another country who is offering to highest return. And with this difference, you are getting a carry trade and arbitrage condition. This is a carry trade return. But the higher return in domestic currency is something else. It is just a deposit return. You are putting the money in the bank and they are offering a return at the end of the year. I think the question is answered. My presentation is end up today. If you have any further okay, another question is coming. Hi, Doğan. In the case of Ghana, who gone to the IMF for a bailout, how will this affect the economic recovery from the COVID-19? Okay, this will be the last question. As I said a few minutes ago, if you go to the IMF to get a support for your budget deficit, for your government current account deficit, for your country's deficit, for your payment and obligation, you can get support and capital from the IMF. But IMF will not give this money like a bank to you, and you can't spend those type of money as you like. They will send their expert. They will send their attendants to your government and Ministry of Finance, and they will directly follow your obligation. They will follow how you spend those money and how you will invest those type of money at the end of the year. Because if the IMF giving the money to your support, it should be contribute to your macroeconomic risk outlook and your return. Otherwise, there is no need to give that money for the IMF perspective to you. It is not a bank. It will directly try to get your recovery in the macro dynamic indicators. If you couldn't achieve that, IMF, if you don't promise that, IMF will not give that money even if you offer 100% interest rate. Okay. This is the end of the session. If we meet in the next session, I think in the next couple of weeks, we will try to cover and deepen our analysis in financial market, interest rates, stock exchange, macro indicators, and those type of macroeconomic topics as well.
Thank you, Dr. Dogan. Thank you, everyone, for your time, and see you again tomorrow at the same hour for another class.